I am AI Avatar of C. Ratan Mundra. If you're planning to establish a global in-house center in GIFT IFSC, or you already operate one, the IFSCA GIC regulations 2025 significantly changed the game. These regulations redefine eligibility, operating models, service scope, and compliance architecture. In the next few minutes, I'll break down what has changed, what it practically means for your structure, and the execution checklist you must follow. A GIC unit is an entity established in an IFSC to provide financial product or service support to its financial institution group or FIG. The model can be captive, bought, joint venture, or hybrid, depending on how the group wants to structure ownership and operations. The regulations widen the service basket, including TechFin, support functions, and specialized financial services. However, the client universe is restricted primarily to non-resident group entities, which structurally limits open market revenue expansion. Only financial institution groups can apply. This includes banks, NBFCs, insurers, brokers, funds, exchanges, depositories, and custodians. There's also a critical jurisdictional filter. The applicant, promoter, or parent entity must not be from a FATF high-risk jurisdiction. FATF screening becomes a transaction-level risk filter. For bot structures, documentation quality, especially authorization, directly impacts approval timelines. A GIC may be set up as an IFSC company or LLP or a branch of an existing foreign entity. This choice affects governance, staffing, and regulatory control. Branches are faster to establish. New entities provide better structural clarity and governance independence. Your decision should align with long-term operational scale. All applications are filed through SWIT, the single window IT system. After review, IFSCA grants an in-principle approval with conditions to be met within 180 days. If deficiencies are identified, you get a 30-day correction window. Treat 180 days as a regulatory execution milestone. Deficiency correction is not a formality. It is your last structured opportunity to avoid rejection. GIC units may provide TechFin services, ancillary services, BATF, banking, accounting, tax, finance support. But services must primarily be delivered to non-resident group entities located in FATF-compliant jurisdictions. Your revenue model must be structured around cross-border service delivery. Contracts, invoicing, and data governance should be internationally aligned from day one. Services may also be provided to Indian group entities. However, revenue from India cannot exceed 10% of total annual GIC revenue. There is one exception: onshoring. If services previously delivered from overseas are shifted to IFSC, the cap does not apply, but prior IFSCA approval is mandatory. If India revenue may scale, secure onshoring approval early and maintain documented evidence of prior overseas delivery. IFSCA formally recognizes 4 models: captive, full ownership and control; bought, third-party builds; then transfers, JV; shared ownership; hybrid; core captive plus outsourced support. Bot models require clear transfer triggers and compliance transition planning. Hybrid models require governance separation between core regulated activities and outsourced functions. GIC units must submit operational and financial reports, with financial reporting in USD. Existing GICs must appoint a full-time principal officer and compliance officer within 90 days, both IFSC-based and fit and proper. Employees may transfer from Indian group entities, but you cannot establish a GIC merely by shifting existing Indian contracts. Local regulatory accountability is now mandatory, not symbolic. Registration remains valid unless suspended or cancelled. However, you must maintain a valid SEZ letter of approval simultaneously. Any material change, shareholding, group definition, business model must be reported immediately. You are operating under dual-track regulation, IFSCA plus SEZ framework. Create a compliance trigger matrix internally. Application fees, recurring fees, and notified charges apply as per IFSCA circular dated 8th April 2025. Payments may be in USD or INR depending on structure. Budget regulatory costs alongside operational setup. Do not treat fees as incidental. To execute correctly, validate FIG eligibility and FATF exposure. Select legal form and operating model. Prepare complete SWIT documentation. Appoint IFSC-based PO and compliance officer. Structure revenue for 10% India cap or seek onshoring approval. Implement USD reporting and material change governance framework. IFSCA GIC regulations 2025 are not just procedural changes. They reshape how IFSC GICs are structured and governed. Stay compliant. Stay structured. Subscribe for more regulatory breakdowns. Moonsys and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence. A pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup. Operational support and handling compliances, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BAT, and ancillary regulations, and fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.